Congress has two big things that they need to do in September. The first is raise the debt ceiling, and the second is to pass a resolution to fund the government. But investors beware. My guest says this could come with some market volatility. Leslie, I'm going to start with your chart. You have a chart showing the VIX index, which measures the implied volatility of the S&P 500. Data from this index is provided by the Chicago Board Options Exchange, and it's often referred to as Wall Street's fear gauge. It shows market swings up or down. In your analysis, you look at the historical VIX data starting in August 2015. This is at the left side of the chart with a peak of around 40. The spike we see here stemmed from fears of Brexit, oil dropped below $40 a barrel, and concerns mounted that China's economy was slowing. The green line continues all the way to this month, where we see it tick higher to around 17, as investors focused on perceived turmoil in Washington and higher tensions between the US and North Korea. At the end of the day, the thing that causes volatility is really investors that are worried or nervous. How do you think people are feeling today?
Well, overall, I would say investors have been feeling fairly comfortable. We have been through a period of relatively low volatility by historical standards until very recently. You see this little spike up at the end of the chart. The initial part of the spike up was on concerns about tensions with North Korea, when the president was making some very strong statements about North Korea. More recently, what we saw last week was market volatility spike merely on the rumor that White House economic advisor Gary Cohn might be resigning. Gary Cohn is viewed as a moderating force in the White House and the person who's taking the lead on the Republicans' key priority of tax reform. So I think that shows just how sensitive markets are to worries that Republicans may not be able to implement their pro-business agenda of tax reform, because even the rumor of the leader on this file leaving saw markets worry. So if we get into a standoff on Republicans not being able to raise the debt ceiling and pass a measure to fund government, this will worry investors about the rest of Republicans' agenda, whether they can get tax reform done. So I think this has shown us that I think markets are quite sensitive to the ability of the Republicans to implement their agenda.
One of the things we did see is in 2011, we came to a very last-minute decision from Congress, and the S&P dropped by over 10%. How does the market compare now to what it was back then?
Well, I don't think we're in the same place as we were in 2011. In 2011, the government budget deficits coming out of the Great Recession were much larger than they were now, and S&P, the credit rating agency, had the U.S. government on a negative watch. It had effectively warned the U.S. government that if we don't see a creditable plan to getting your budget deficit back under control, we are going to downgrade you. And with the standoff that occurred and the debt ceiling being raised at the very last minute, a few days later, S&P indeed downgraded the U.S. government. That had never happened before in history, and markets tanked. So we don't think we're in a 2011 situation now, partially because S&P has recently reaffirmed the U.S. government's credit rating as stable. So we don't expect, even if we see a standoff in the debt ceiling and a last-minute deal, we don't expect a credit downgrade. So we don't expect the same sort of 2011 situation, fortunately.
In your report, you do highlight a worst-case scenario. What could that mean for investors if we head down that road?
Well, a worst-case scenario is, if markets lose faith in the Republicans in Washington's ability to govern, to get the tax reform passed that they've been promising, and you see volatility spike up to those 40 levels. Just to take you back a little bit in history, after volatility spiked in 2015, the Fed delayed raising rates. Markets as recently as July 2015 had been expecting the Fed to start raising rates for the first time since the recession. Right now, markets are expecting the Fed to start normalizing its balance sheet in September. So if we saw that kind of volatility, which is not our base case, just to reassure you, you could see the Fed delay the process of starting to normalize its balance sheet in September.
Thanks very much for coming in and bringing your chart.
My pleasure.